Hey, this is Sasha Evdokov, and thanks for joining me here at tradersfly.com, where I share with you insight about trading, investing, and the stock market. Now, in today's video episode, what I'd like to do is share with you what is a stock sympathy play and how can you use it within trading, or why you may use it in trading. And I find that this happens a lot during earnings, or people trade these sympathy plays throughout earnings. And sometimes it happens due to sectors, sector news, rules and regulations that also impact things. So it's something to be aware of. I don't use this technique a lot in my trading, but there are certain situations where, as you see things happening and evolving, you may decide to trade based on a sympathy play. All right, so to get things started, first off, what is a sympathy play? Well, a sympathy play is something that you go ahead and execute or play based on something related. So if we go ahead and look at a watermelon, and you also take a look at an orange, these are fruit and they are related. So they're related to one another in terms of them being fruit. Now in the stock market, you also have relationships that work together, and they work together in really unique ways. So for example, what you may end up happening or having the relationship is you may have Baidu, which is a search engine, a Chinese search engine, and then it also relates to, for example, like the Googles. Now you can also say that Baidu is also related to the Yahoo. Okay, so Yahoo, Baidu is also related from one another because these are all search engine based. Now if we take things a little bit further, you can also say that, well, Yahoo is also related to Alibaba. So these two are related, and these two could be a potential sympathetic play if something happens to one or the other. So really what you're doing here in this situation is you're mapping out relationships. So that's what it really comes down to when you start looking at all the different stocks and how they move, how they trade, is that it really comes down to relationships. Okay, so now you have a basic understanding of relationships in the stock market, but how does this play out in trading? Well, let's say, for example, that there is a bigwig or a pretty wise guy, could be a serious investor, that's really interested in investing in one of these companies. It could be Baidu, it could be Google, it could be Yahoo. Whatever the investment is, he's interested in one of them because he's betting on these search engines. He's betting that search engines are going to be huge in the future. It could be that, because internet growth is going to explode in the future. But in either case, he's looking for search engine growth. So what he does is, let's say he invests in the Google. So once he invests in Google, he is betting on search. And this investment could propel that stock extremely high. Now, he might have gotten into this investment right around here, and this stock exploded and continued to move to that upside. And now it's currently, somewhere all the way up here. It's very high. So it's already moved past, let's say, a fair opening price, or a price that you would want to get into. It's way beyond where you'd want to get into. So what you could do is go to the next area or the next company, and you could say, okay, well, I like that idea. I believe search engines are going to grow, so I might invest in Yahoo or Baidu or one of those things. So you might decide to say, well, I'm going to invest in the Chinese search engine, which would be the Baidu. So you invest in Baidu and with it in hopes of later in the future catching that upside move similar to what Google did, because you're investing in that sector or segment within search. Now, these kinds of things can happen at any time for any industry. So for example, if Yahoo releases earnings first, what may end up happening is if the earnings are fantastic and great, then more people may decide to purchase Alibaba because they assume, well, Yahoo's earnings are great, so probably Alibaba's will be as well. Or it could be the reverse. If Alibaba reverses and says, hey, our earnings are fantastic and great, and since Yahoo is an investor of Alibaba, at least for the current time being, then what may end up happening is people may decide to go ahead and purchase Yahoo and say, well, if Alibaba had great earnings and Yahoo is an investor, then probably Yahoo stock will also continue to rise and increase. So that's how people really start looking at these sympathetic plays. Now, these sympathetic plays can happen even in sectors. So as you start looking into, let's say, a health sector, it might be in the healthcare industry, then what can happen is if there's rules or regulations or anything like that that are being passed, let's say by Congress, by the board, anything that happens between these healthcare stocks, healthcare sectors, or things that are going on within the government, that can affect these healthcare stocks. So it could affect the drug makers, it could affect people who deal with healthcare insurance. So all those things are to pay attention to. So what people may do is, rather than playing directly to, let's say, the drug companies or the pharmaceuticals, what they may end up doing is playing the healthcare insurance companies. So now you're kind of playing something slightly different, but still related. So that's really what a sympathy play is it's based on the relationship that a stock has and how you decide to play that relationship from another company because it's sympathetic and related to it. So just like here, Baidu is related to Google, and Google could be related to Yahoo because they're partly search engines, and Yahoo's related to Alibaba. So if something happens to Alibaba, things go up in price, things go up in value, they make more money, then Yahoo can be affected. Or let's say a big wig investor goes and says, hey, I want to buy the search engines, or I want to buy a bottling company, or I'm thinking that oil is going to be huge, or I'm thinking that solar energy is going to be big. So they invest in a solar company. But that move already happened. So what do? What can you do if that move has already moved? Well, what you could do is get a sympathetic play, something else. It might not be a watermelon, but it might be an orange. It might be something slightly different in hopes of catching that run as well to the future. And that's how people move in the stock market, as they flock to one area or another. And the same thing can happen in sectors such as a health sector, it could be a pharmaceutical sector, airplane sectors, aerospace and engineering sector. There's a lot of things that can happen. It's all based on these relationships that are composed within the market, which stocks are related, which stocks are in a certain group or sector, and how one can affect the other. In the end, sympathetic plays is not something that I use or employ all the time. It's just when something is happening, there might be a news event, a news catalyst that's moving a certain stock. That's why you see other stocks in that sector or industry moving. So it could be something that you might want to put in your toolbox and sometimes whip it out and use it if necessary. So thanks for watching me in this video and watching this video lesson. If you enjoyed this video lesson, you want to see more videos like this one, then go ahead and click this button right over here. And when you get there, enter your name and email address, and I'll send you more free training videos as they are released. And that way you'll stay up to date when I release new training and new material. Now, if you want to see some of the books and training courses that I have available that are really in-depth or much more in-depth than these videos, then click the button right below this video and you'll be taken to that page. In the end, remember to do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.